Hi everybody, Alex Deploy here from Expert Forex, and in this video I'm going to do a very optimistic thing. I am going to try and convince you that you should never use a stop loss. And I've seen more and more abuse of stop losses to the extent that traders are even using stops for their total account. So if their account reaches, let's say, minus 20%, they would close all their deals and start over. But let's take a closer look at stop losses. Okay, so firstly, what is a stop loss? Basically what happens is here you are, you're entering a buy transaction. There's the target you want to go to. But you're scared that you might get the direction wrong, so you put a stop loss in. In other words, if the price comes down to that level, it will close the deal at a small loss. There's the small loss, and you will be a happy chappy because you have managed your losses. And in many cases, that gives the trader a warm feeling. Now, I've had a number of mentors through my career, and I remember one of my mentors used to say, if you want a warm feeling, just wet your pan. Anyway, and this is how I started trading. I was taught to put a stop loss. Whatever you do, do not trade without a stop loss. So I was taught to put a stop loss in and trade this way. But I found I wasn't as successful as I should be using these stop losses, and then the discussion came up as, where should you put your stop loss? Should you use small stop losses with a big target? And what happens when you use a small stop loss and a big target? You have a low success rate because the price will hit your stop loss a lot more often, and you'll have a high return on risk. So in other words, when you're successful, you will most probably make twice as much as what you're risking. But in the end, the two offset each other, and you'll make a small profit if you're lucky, but you essentially will stay where you are. And this has been our practical experience when we started. And I was lucky enough to trade in a group of really switched on traders. And this is what our conclusion was. Small stop losses, low success rate, and high return on risk, but you stay where you are. Then we tried the opposite approach. What about having a big stop loss, small target? So this was actually a lot better. We got better results using this because the success rate was very high. The price battled to get to our stop loss, and we had a low return on risk. So we had to be that much more successful to make a profit. So again, we were in a situation where we were making small profits and we were essentially staying as we are in a bad month. Plus, I was getting a really demotivated when my transaction hits the stop loss. There is no denying it. You feel absolutely terrible. So we started looking at what happens if we trade without a stop loss. So we started asking questions. What is the value of a negative deal? Should it be closed, or should it be hedged, or what kind of thing? And we started throwing ideas around about not using stop losses. So the first idea that came around was the grid trading system. Now, a lot of prop firms actually ban the grid system because it is so good. So how the grid system works, and I'm just going to do a basic example and I'm trying to just teach the concepts of grid trading in a minute or two. So there are a lot more aspects to it, but I've got a whole video that explains it. But essentially how grid trading works is you start over here and you enter in a buy and a sell trade. So in other words, you hedge. There's no risk. Then let's say in this example, the price goes up. What you do is you cash in your buy. So that buy transaction is positive, you cash it in. And step two is you enter another buy and another sell. Simple as it's a mechanical system. Just follow what I'm saying. Then let's say in this example, the price goes down back to the starting point it was over here. So what you would do is you would close all your deals. And why would you do that? because you have made a really nice profit out of this transaction. Firstly, your buy number one, as we've seen, you've cashed that in at 100 pips, 100 pip gain. And again, I'm ignoring spreads because I want to keep the example simple. Then the sell went down 100 pips and you cashed that in. So that sell number two was cashed in at 100 pip profit. Sell number one, this one here you entered here, is at break even because it's back where it started, so it's at break even. And then buy number two, which is that one over there, is negative because it was facing that way and the price went that way. It made a loss of minus 100. But if you add them all together, your result is a nice profit of 100 pips. So that is the basic concept of grid trading. No stops are used in this method, and it has been one of our most successful trading robots ever because you can adapt a whole lot you can change the grid sizes, you can change the lot size, you can do all kinds of things to make it really creative. So if you want more information about grid trading, here's a very popular video. It's had over 174,000 views in the last 2 years. So go and have a look at this if you want more information about grid trading. Now, if you look at these little dots on this grid, they will blink at you. Just look at them and they'll blink at you. That's how clever grid trading is. And here's the grid trend multiplier, which trades the grids again and again. If you look at the grid that you see here, you'll see some dots appearing in the corners like that, and don't worry, that's normal if you see that. But essentially it's ideal for a beginner because the direction doesn't matter whether the price goes down or up. The grid principles make sure that you make a profit. So that's the first method that we found where we could trade without using stops. And the big key thing with grid trading is you have to select a sideways currency. You've got to select nice big grid sizes, and your lot sizing must be very good. Anyway, so this got us out of the mindset of having, hey, you've got to have a stop. And this is part of what I'm trying to convince you about. You don't have to have a stop. There are people out there that trade without stops because they are partially hedged. Okay, so let's move on from the grid trading, and this is how my personal trading has developed and the group of traders that I was involved in, how it then moved on. So let's go and have a look at the next stage. Okay, so then one of the traders said, well, why do we need grids? What we could do is if we have a buy and it goes negative, all we do is we buy again. So that's a simplification. So it goes down 100 pips and all we do is we buy again and it goes up again. So buy number one is at break even. Buy number two is at plus 100, result plus 100. So that's a simplification of grid trading. So we're not doing a buy and a sell at every level, we're just simplifying it that way. So if you look at this is actually a top-up method. So you've bought there, it's gone negative, so you've bought again. So what we call this is a top-up method. We're buying again. Against the trend, we're buying. So that's a top-up method. So out of grid trading came the top-up method. And then we actually extended and said, okay, the example I used over there was really simple. Let's say you have a buy number one, a buy number two, a buy number three, and buy number four. So you've just gone negative, negative, negative all the time. All the price has to do is move up a little bit and you get out with a small profit or you break even. Now let's do the sums here, and let's say the price here has gone down 300 pips. It's 1, 2, 3. It's gone down. It's opened 4 buy transactions, and then it goes up 150 pips. Now, again, this is an example. There are ways of manipulating this so that it only needs to go up 100 pips or 90 pips to get to a small profit or break even. There's also ways where you can change the distances between the transaction and that type of thing. So there's a lot more, but I just want to show you the simple transaction. So let's say the price then goes up 150 pips. So buy number one will be down. Buy number one will be down by 150 pips. That's at 100 and then a 50 over there. Buy number two will be down 50 pips. Buy number three will be up 50 pips, and buy number four will be up 150 pips, and therefore that's how a break-even situation is developed. Now, if you want to move that line just 10 pips that way, then you suddenly in a profit of 40 pips, and that's how the top-up approach gets developed into something more creative. But that's how the top-up approach works. And what the top-up approach is, let's say I'm right with buyer number one. Fantastic, I cash that in and I'm successful. So then you just go to the next transaction, and the minute you start running into a losing transaction, you don't use a stop loss, you just add another buy. Then you run into, then it gets even worse, you just add another buy. Then it gets even worse, you add another buy. So that's the alternative to using stop losses. And it might look risky, but what I'm going to show you in a while will show you that in practice, and that's the most important thing, in practice, not theoretical, in actual proven results, this works. Okay, so what we did is we actually built a robot that is called the profit retriever, and as you've seen in the previous slide, that's exactly what it does. It goes into a loss and then retrieves the profit. It actually brings you back into a profitable situation, and as it says there, it makes profits no matter which way the price moves. If it moves in your direction, you cash it, and if it doesn't, then all it does is we go into the profit retriever process and it will make a profit for you. Fantastic EA. Let's go and have a look how fantastic it really is. And to do that, all we have to do is go to our Link to Success service, where you can link your trading account to successful and proven robot strategy. And here's a list of the accounts that you can link to. Now, it's a big list. It has 79 accounts in it. All of these accounts on this list are positive. In other words, they have a positive equity. So the average age of these 79 accounts is 242 days, and the average gain is 86%. So that you've got 79 accounts that have almost doubled their balance, and many of them have. You can see here's one that's doubled its balance, and that's gone 3 times its balance. There's another one 3 times its balance, that type of thing. And the average success rate, if you look down this list, is 66%. And the average monthly gain, now this is monthly, you must just remember it's not annual, it's monthly, is 11%. And the average dollar gain on the average account in this list is 966. So this is a list of highly successful trading accounts. And if you look down the list now, the PR stands for Profit Retriever. Prop Cruncher is using the Profit Retriever principles. It's actually now called the Wave Liberator, and it uses exactly the same principles. So if you look down this list, you can see that those principles that I've just shown you, the one where you top up as this trade is going in the wrong direction, work perfect. They are proven. High success rates, high account gains, and you can see some of these accounts that use this principle generate fantastic monthly gains. Here's one that's generated almost 70% a month. Now just think about it, 70% a month. I don't know how much you're paying on your home loan or whatever, but 70% a month is a pretty good return on your investment. So the objective here was to show you that the top-up system that came from the trading system works fantastically. Now, one of the disadvantages of the prop retriever is it only trades one currency at a time. For instance, there's the profit retriever, it's only trading the euro. That one's trading the yen. There it's trading. But we have now created variations of the profit retriever that now can trade a wide range of currencies in one go. So what happens is you have an instant portfolio. Now, trading portfolios is fantastic because it spreads your risk, and if one is doing badly, the other one will do well, and so on. So you have an instant portfolio when you use the new EAs. And let's go and have a look at those new EAs. And the one is called the Wave Liberator. So in other words, this one basically, rather than using a random entry like the profit retriever does, it says, okay, we're going to wait for really good signals, and this one trades breakouts. It's a with a trend breakout trader. And then we have the RSI Liberator, which is a retracement trader, and it trades when the trend is mostly over, and it will trade in the other way. But it uses the same concept, the top-up concept, to recover if it has made the bad decision. And these EAs are trading really well, and as I say, you have a built-in portfolio when you use these EAs. And here are some of the tests that are currently running in, and you can see that the equity balances are really nice, and all of these are positive that are running right now. So I hope I've convinced you that you should never ever use a stop loss again. There are so many techniques that you can use that you can recover your losses if you do have losses, or you can cash in straight away if you have successful trades. But certainly you don't need to go through the agony of seeing your stop loss being hit. That is a terrible thing. When I changed to no stop loss trading, my whole life changed. I basically sleep like a baby in the evenings. Again, I hope you've learned something from this video and that you found it interesting. And as always, the links to the items mentioned in this video will be in the description of the video, as well as in the first commentary. I urge you to go and have a look at those links and get more information about these no stop trading techniques. From me, Alex Deploy, cheerio.